A global risk-on surge swept Wall Street after Iran declared the Strait of Hormuz completely open for commercial traffic, erasing much of the fear that had gripped energy and equity markets through weeks of the Middle East conflict. I want to bring in David Busch, the co-CIO of Trajan Wealth. The firm has $2.6 billion in assets under management. Like all of us, he's been watching these developments very closely. He joins us from Scottsdale, Arizona on this Friday afternoon. David, the president is talking about this like it's the end of this conflict. Markets are seeming to at least price it like there's some good news on the horizon. Is this the end of the conflict in your view?
Well, it's to be determined, honestly. What we've seen over the last several weeks since this conflict started is this headline risk, where we get a sense that things are starting to calm down, but then another headline or an escalation will happen, and then we're right back to where we were. But I believe that this is a good step in the right direction. And really, I saw just a headline just a few moments ago that Iran is saying like the Strait of Hormuz is open, but they want the blockade to move out of the way. So it'll be interesting to see what happens over this weekend. But these are all good signs pointing to a ceasefire and hopefully peace talks, permanent peace talks.
Hey, David, signs that you trade off of?
Signs that I trade off of?
Yeah, I'm just saying, like, is this what you're getting now? Is this something that you feel comfortable enough that you have enough transparency that you make some trades off of it, or you think about kind of a longer term trade from here?
Yeah, I'm generally a long-term investor, and that's sort of our stance. But I will say that the sectors that have performed well or that have been beneficiaries, and I hate to use that term, but beneficiaries of this war is like energy and defense contractors and so on. Now we're seeing a pullback in some of those sectors and a rotation back into some consumer discretionary and so on. But having said that, given where price of oil has been and where it's at today, we have to remember that even if we have a ceasefire, what we're going to have is a period of 12 to 24 months to rebuild that infrastructure that was taken offline due to the bombings there in the Middle East. So the price of oil, I don't anticipate that it's going to drop back down to pre-war levels. I mean, we may
Ever
come back into that $75 range, but I would just stay invested long-term and diversified.
Not drop back to $60 a barrel ever, or in the near future?
I just think in the near term,
okay,
like over the next 12 to 24 months,
because
of that infrastructure.
Then what are the implications of that?
Well, it means that we're going to have that continued inflation from higher energy prices, which we saw in the latest CPI and PPI numbers. And that inflation has to permeate the economy. And unfortunately, it touches every sector of the economy. So I would expect that inflation related to energy costs is going to stay elevated, and consumers are going to continue to feel that pinch at the gas pump. But ultimately, I think we'll get some relief here.
Yeah, I mean, if you look at, we've talked about this a bunch. If you look at crude oil futures, WTI, I mean, we're still looking at, oil in the $72 a barrel range. So we're not anywhere close back to where we were prior to this war. So you definitely see a bit of a floor here, right? And that's going to certainly feed into a lot, and certainly as energy as a trade. How do you think about, like, along those lines, David, and this is something we talk an awful lot about here, or I have been certainly focusing on, but I think the rethink of supply chains, and when it comes to crucial things like energy or rare materials or just basic commodities, like the world kind of rethinking what happens in times of geopolitical strains or conflict or wars.
Yeah, that's right. And this has been eye-opening, especially when we look at some of the headlines coming across from the European countries where jet fuel price or jet fuel supply is limited. And there was a headline earlier this week that talked about they have maybe 6 weeks left of jet fuel supply. So you're exactly right. There are supply chain disruptions that have happened because of these geopolitical conflicts. And what that means is that we as a country have to be energy independent and less reliant on foreign sources of energy. And what that means is likely a portfolio of energy sources.
Mm-hmm.
everything from the typical oil, coal, natural gas, but also those green energy sources like wind, solar, hydrothermic, and so on. And I think that we have to become more energy independent so that if in times like this, when we have geopolitical risks and supply chain disruptions, that we can continue on as a country and not feel the pinch like we've had over the last several weeks.
Yeah, I mean, I think a lot of people would agree with you. I don't know if the policymakers would agree with you right now on the renewables part, though.
Right. And it's kind of a walking a fine line or a good balance. But I think that at this point, we almost have to consider several different sources of energy, including nuclear. When we not just in light of the supply chain disruptions, but also think about the AI infrastructure build out and these data centers and the power that's going to be required to electrify them and provide this AI technology. We're going to have to pull from several different sources, and I don't think anything should be off the table in terms of an energy source.
David, for something like nuclear, that is something I feel like, Tim, do you remember when we did, was it NJIT?
Yeah.
And that's several years ago.
Yeah, and Scarlett and Paul were there earlier this week.
Right.
And we were talking about different sources of energy.
But when we did it a couple years ago, we were kind of shocked that, at least I was, that all of a sudden they were talking a lot about nuclear energy again. And this was, I feel like, even ahead of the AI build. Having said that, David, folks in the industry say it's a long time before you really start to see whether it's SMRs, the small modular reactors in terms of nuclear, you really actually see them online and performing. So it's a little bit of a longer term play. Obviously, there's some old facilities that, I guess can be rehabbed and up and running again. What's the advice to investors for you? If you've got clients who are saying, what's my play here when it comes to nuclear? Do you hold off a little bit because it's going to take a while for that to actually get online? Or is it something is this you're long-term, you said, and reminded us, is it too early though, or too long-term for investors right now?
Well, I think that it's one of those sectors that we need to consider, and I think that right now I think you're right. These small nuclear reactors, they're still years away from being put into production and online and usable, but at the same time, it's one of those that, from a diversification perspective, and also thinking about the future and the future energy needs of the country, I think that it's something that I'm considering for sure personally, but it's also one of those areas that if somebody gets into it, they have to think about that long-term horizon, that 5, 7 to 10 year time horizon before these actually come online.
Yeah.
And so the payoff will be further out in time.
Yeah, the regulatory environment and just the logistical challenges of where these will actually be built are still up in the air. We don't have any, as Carol mentioned, don't have an example of that. Hey, before we let you go, I just want to kind of push things ahead a little bit to the Federal Reserve and what the drop in rates and the drop in oil prices signals to you about not the Fed's next move, but the path for the remainder of the year. How are you thinking about today's developments and the way that rates are going to look?
Yeah. So what I think is going to happen at the next federal FOMC meeting, Federal Open Market Committee, that's happening on April 28th and 29th, is that they're going to hold rates steady, and we may get perhaps one rate cut this year. But really, when we think about their dual mandate, it's really the labor markets and inflation. So labor markets have at times softened, and then we've seen some bright spots. At the same time, inflation is still persistent, and we saw that increase in PPI and CPI. So there's really no catalyst for the Fed to cut rates in the near term. And as this inflation permeates the economy, and we think about what the Fed may say and what they may signal, is we're looking for words like transitory.
That's not allowed
versus
anymore.
Permanent inflation.
Yeah.
That word's not allowed. That's been banned, apparently.
I know. That's almost a swear word at this point.
Yeah.
Transitory.
All right. Hey, listen, David, thanks so much. It was good to get some time with you. David Busch, he is the co-CEO of Trajan Wealth.